So welcome to the recording from an Everything Marketplaces group event and chat that we had. I'm actually going back and reshooting an intro for it. It was a really incredible chat with Bryce from Indie.vc and Janessa from Simply Eloped, which is a portfolio company and marketplace for Indie.vc. So this is a really great chat. We were thinking about originally doing it in a workshop format, but decided to just do a casual kind of conversation and open dialogue here with the group. With Bryce sharing a little bit more on Indie.vc and funding options, and then also Janessa sharing more on her experience with Indie.vc and funding options as an early stage marketplace. So I know you're going to enjoy it, and we're just going to jump right into Janessa giving a brief kind of intro and having a conversation with Bryce.
Sure. Yeah. So I'm co-founder of Simply Eloped. We're coming up on our fifth birthday. And obviously we do elopements nationwide, top to bottom, the ceremonies, make it really streamlined, have our own technology. Check us out, simplyeloped.com. But the real meaty story is when we found Indie.vc. So we were about 3.5 years into our business and kind of ran into this interesting cycle where like we get a huge influx of customers, and then we had to hire a bunch of people to like manage those customers and like watch over the ceremonies, and then we'd like need more customers to pay for those people, and so it just was like this growth cycle that we really want to get out of. But I was pretty anti traditional investment and had a pretty bad attitude about it, and so when my co-founder and I were talking about options, I was like, look, I just don't want to go for like the multi-million with giving away a bunch of your company. That's not interesting to me. And I've seen it really blow up in founders' faces. So we started looking for alternatives and found Bryce and Indie.vc and started investigating. And from top to bottom, it really resonated with us, like everything that Indie's about, from the like founder friendly, to the burning unicorn, to kind of being the rebel of the industry. We just felt like we'd found like a kindred spirit both in Indie and in Bryce. So we applied. Obviously, we got in, and we've never looked back. Like we've loved making that decision. We're so grateful to be a part of the cohort, the community, to have Bryce on our side. In every single way, it has made a huge difference in our company. So that's kind of like our intro story. Bryce, I have some questions for you if you want to just launch into it.
Let's do it.
Okay, so I would really love to know where the idea and inspiration for Indie even came from. I actually don't really know the story from your own perspective.
So, it was kind of this series of breadcrumbs that kept getting dropped that I kept following that were increasingly interesting. The first one started way back, with an investment we made in a company called Foursquare, which is relatively well known now. But when we closed that initial investment, I remember having a conversation with Dennis, the founder there, and him kind of looking me dead in the eyes and saying like, look, I don't want to raise any more money. Like, we know how to build this business. I want to do this with like a really tight knit group of people. We know we're already bringing in revenue. I want to stay off that treadmill. I want to control my own destiny. And, fast forward, there weren't a lot of options for someone who wanted to control their own destiny. And certainly there wasn't, kind of any aspirational path for them to follow to do that, and kind of get the support of investors. And so, Foursquare has now gone on to raise hundreds of millions of dollars. That company, most of the people, nearly all the people that we funded initially with that business are out of it. It's doing 100 plus 200 million in revenue a year now, but it's been a really long winding journey. And I just, that was probably one of the early seeds, was like, wow, I wish if he really did want to build like that, I wish there were alternatives for him to do that. And then, I think just being part of the mainstream startup stuff that was happening back in, 2010, 2015. I mean, we were one of the very early kind of institutional seed funds that were stood up. It started to feel like people had really lost the plot on what building a business was all about. It became far more about funding and valuations than it did about, kind of value that was being created for customers. And so, the kind of intersection of the kind of dentist thread was, was just living in Utah. I live in Salt Lake City, Utah. And when I looked at like the companies here that were really starting to scale and have an impact, even the ones that were raising, large rounds of funding, they were raising it so much later in their life cycle. And so as I spent time with these entrepreneurs, the story that I heard from them was just so consistent that yes, it was harder. Yes, they could have maybe avoided some of the struggles they had in those first kind of 5 to 10 years of bootstrapping, to a fairly venture scaled business, but that they wouldn't trade the focus on and the culture that was built around this idea of putting customers and revenue first versus kind of what was fundable. And I think in most of the cases here in town, those were businesses that in the moment that they were starting them, or in the kind of the industries that they were in, they were way out of the kind of hot sectors that investors were chasing at the time. And so in many respects, they would have had to kind of really contort what it was they were trying to build into what investors were looking for. And I think, the kind of overlap of those stories, and then, I mean, you and I've talked a lot about this, right? Like, and I think hopefully we've played some role in kind of elevating this conversation, but, when you look at the, kind of pattern matching of what drives investing, it became pretty clear, as an early stage investor that, our customer realistically was the kind of next investor. And so when the lens you're looking at investments through is like, who will be investable in this really narrow window, you start to see this kind of crack in the foundation of this meritocratic story that we tell ourselves about entrepreneurship. And so, I think we have a lot more healthy and robust conversation about diversity, inclusion, the amounts of funding and where they go, be it geographically or demographically. But I think we found, at least in the early indie days, like part of the original thought was like, what would get funded and what could reach that kind of scale if the goal, if you weren't totally beholden to all the pattern matching upstream from you. And so, I think all of that was kind of that indie stew that came together and that we've been, kind of simmering ever since.
So it seems like 2020 really coalesced the idea of like some of these, similar funds that I've really seen launched like over the last year, and then some of the like newer ones like Earnest. But Indie's been around for 6 years. So I'm curious to know, just personally, like, was that a hard pitch? I mean, it was such a different idea 6 years ago. And, I'm sure like to most LPs, they're like, why, like, what's the point, investing 150 to 500K and making it founder friendly? Like, as an LP, I would imagine that 6 years ago, I don't know if I would have been interested in something like that. So I'm curious, like, was that a hard pitch? Like, was that a difficult conversation, or did you just get like people signing up left and right? And I'm just so curious, like, that transition in model, was that like a difficult thing to get locked and loaded?
You're talking about it like it was difficult in the past tense. It continues to be incredibly difficult now.
I was hoping that was a different answer.
I would say 6 years ago, we kind of did our V1 of Indie, and it was a very like, intentionally designed to be a bit of a punch in the face to the traditional venture industry. And I think, anytime you're trying to get attention or build a brand, you can't just like be for everybody. You kind of have to pick your audience. And we felt like there was this kind of growing resistance around, some of the feelings that you felt, right, about, traditional investing. And so, prior to, that experiment, or V1, was done as part of an $85 million fund that we were already managing. And we told our investors, like, look, we think there's an opportunity here. We kind of highlighted a bunch of these companies that kind of fit that narrative, and that, kind of relayed some of the tea leaves we were reading, in startups at the time, to give you a sense of how enthusiastic they were about that idea. when we decided to make Indie the kind of primary investment strategy of between Fund 3, which was 85 million, and Fund 4 clocked in at 25 million. And so, you know, we lost roughly 80% of our LP base. And I think, you know, despite having so many stories that you could put out there about, you know, GitHub and Qualtrics and Pluralsight and, you know, at the time, MailChimp and Basecamp, and you could, you know, Atlassian, you could walk them through all these stories of venture scale businesses that didn't take the blitz scaling path. That's still just a really hard concept for them to really grok, because eventually all of those ended up raising venture capital. And so, you know, and at the same time, like, you know, I mean, I can speak for our funds, right? Like you know, our more traditional venture funds were throwing off, you know, call it 5x net returns. And so what they really wanted to hear was like, hey, look, see this working? Like, we're just going to keep doing that same thing. What they missed was, yes, we were seeing those similar kinds of outcomes across our portfolio. But if you look at how those outcomes were being driven, there was this kind of consistent shift in ownership narrative markets that, you know, kept pushing our ownership down and started to show that the kind of traditional seed narrative was just getting compressed from both sides, right? You were getting all the major funds developing and standing up and being far more aggressive with seed programs. And then you saw this kind of new generation of the Airbnb, Uber, like all these angels or the early employees of these companies that were really starting to, you know, kind of come out of their own, you know, into their own as individual investors. So whether that's through rolling funds, whether that's through syndicates, or whether that's just as individuals, you know, I call that kind of the atomization of seed. You used to get these like big meaty ownership positions early on, but now with rising prices and, you know, kind of more slices of the cap table, it's, you know, it was going to be harder and harder to kind of generate those returns. So I think the simplest way to answer your question is, yes, it was a really difficult transition for people to make. Two, it hasn't gotten much easier when it comes to institutional investors. You know, we can talk about, you know, companies in the portfolio that are growing 10x, you know, 5x, you know, getting into like tens of millions in revenue. And the fact that we're not taking dilution every 12 months and we aren't, that, you know, that founder does control it. And that when and if there is an outcome there, that, you know, we will have preserved our ownership long enough that it will move, you know, even in a small exit scenario, it'll still move the needle far more than even billion-dollar outcomes that we own single-digit percentages of. Without those kind of like mile markers of markups, you know, from, you know, rounds, I think it's really hard for institutional LPs to get excited about it or support it. It falls far enough outside their, you know, kind of business as usual that it's been hard for them to wrap their heads around it. In some respects, it's gotten easier because I think, you know, we have had some LPs who've been on the ride with us who've just gotten more and more conviction about it. And I think, you know, as painful as it is to lose the LPs, it is an opportunity to like bring in the people who do want to be a part of this next chapter and share a worldview that we have.
Yeah, great insights. So I'm really curious, since I've been a part of Indie for 2 years now, I'm really curious, like your terms, if they've evolved, how they've evolved. I'm not sure everyone here knows like about the redemption rate.
Yeah.
You know, so maybe you could just talk about like the terms that you negotiate with each fund and each founder and why you chose those terms. Because I do think that's really a way that Indie stands out.
Yep. You know, I do think it's one way we stand out. I'm not sure it, I think, you know, I have a tortured relationship with our terms because on one hand, I think we're trying to be just totally explicit in terms of kind of optionality that entrepreneurs preserve, but it's new and it's confusing. And I think, you know, even now, 6 years later, we're still having to like walk people through like, and I can appreciate that. I think despite the kind of learning curve that comes with the terms, we have seen like real adoption, particularly outside of Indie too. We've tried to be really transparent in how we've developed them and iterated on them. And, you know, I hear from entrepreneurs and investors all the time how active they are with Indie terms and they're raising on them. And I think it's phenomenal. We wanted to be able to provide that. I think the big difference between Indie terms and maybe what people see traditionally at seed. At seed, you get a, kind of a safe note with a cap on it, and they're designed to convert. That's really a safe note's only job. It's to forestall a difficult conversation around valuation at an early stage. But the idea is each of those is designed to convert into a future round. And I think with the Indie story, and you're a living testament of this. I mean, we've been involved for 2.5 years. You haven't raised any more money. And, I don't know that you will or that you'll want to, but if you do, you'll do it on your terms. And so, our idea was like, okay, if the focus isn't going to be just converting, let's account for that as part of the terms, but let's provide this kind of release valve in the event that, a company decides to just go on and be a big, profitable, scaled business. We need to be able to get our return out. And in a traditional safe note, that's not accounted for, so we tried to account for it in the terms. And the way we tried to account for that was something that was equitable for everybody. One, that if you aren't really going to go for like the rocket ship growth, that you preserving ownership is going to be highly valuable to you and probably less valuable to us. So we set up a structure where, after a set period of time, usually it's 2 to 3 years, we start taking, you effectively start buying back, the equity that we have in your business. And, with each redemption that you make as a percentage of revenue, your ownership grows, our ownership decreases. And so that was the idea with the redemption, is we wanted something clean, and we wanted that for cases where, maybe the opportunity was a little bit more capped, or the ambition of the entrepreneur was a little bit more capped than we both realized when we started in the investment. In the traditional investment community, that usually ends up with an entrepreneur being forced into like a fire sale, or the investor needs to get their investment out at some point, and it just creates bad behavior. So we really wanted just a very clean, articulated way that if that were the case, that's where we ended up. And I think right now we have a bunch of companies that we've actually ended up converting to equity in those companies, and we have a few that are paying out their redemptions, and they're really happy to be doing that. I mean, I think in some cases we've got companies that are doing mid 7 figures to low 10 figures in revenue that have no interest in selling or raising, and now those entrepreneurs own the vast majority of those businesses. So that's the thinking behind the terms of, and we publish them, they're all out there, and we've tried to do it in a way that others can replicate it if they resonate with them too.
So something that I thought a lot, we do have some questions, and we will get to them, but something I thought a lot about, Bryce, since I've entered Indie, is like the community and kind of the mission that you're putting out in the world. That was definitely like a benefit to me that didn't seem as apparent up front. So I'm really curious, and actually, so I would love to talk about like the Scout program that you've built. But as a Scout now, something that I look forward to is like, will someone add to the community? Will someone like help Bryce with this mission? So I would love to hear you talk about like how that became a part of it, and like why personally that aspect is so important to you.
Yeah. Well, years and years ago, I was part of this kind of crazy elite gym here in Utah, and it had a funny name called Jim Jones. And if you've ever seen the movie 300, like they trained all those people. They trained Henry Cavalli or whatever his name is for Man of Steel. Like it's an invitation only, like very serious place to train. And one of their things was like, you become who you hang around. And so if you hang around people who don't want to work hard, if you're just in like 24-hour fitness, like you're going to kind of like gravitate towards like the lowest common denominator. And so, you know, I think one thing that was really important to me from the get-go was to like, to ensure that the people we funded through Indie were like really bought into Indie. And then we surrounded them with other people who are just as bought into Indie, because it's a different path. And if you go to Techstars, Y Combinator, you go to like a, you know, a portfolio meetup of any other, you know, VC investor that's out there, the lion's share of the conversation is about fundraising. And so, you know, when you go to like a startup, any startup event, I mean, 90% of the content is around how to raise money, how to close money, how to, you know, it's all designed around that. And so one of the things that I really wanted to explore right up front was like, how much of a difference would it make if we never talked about fundraising? That all we talked about was building businesses. All we talked about were like the real fundamentals of go-to-market, of revenue generation, of pricing, of like, what if we just made that the kind of primary tenant? And to do that, I felt like we really needed to cordon off a very separate community. And I think as you know, I'd love your feedback on that too, of how you've experienced it, having not raised money before, but coming into it. You know, you have been around startups. I'm curious how you would contrast it, because, you know, the feedback we get is like, it's almost like people didn't really get it until you're in it. And then you're like, oh, whoa, this is way different. And, you know, I think at certain points it became contentious early on. Like, I think we're now relatively well established in terms of the community, but V1, there were two companies I can think of right out of the gate who came back to me within like 6 weeks or 8 weeks, and who were like, okay, let's talk about our next round. And I was like, oh, you totally don't get it. In fact, why don't you just, if you really don't get it, like, why don't you just give us our money back? And like, basically kind of laid down the rule of like, unless you're profitable, unless you don't need to raise money, I don't want to talk to you about ever raising money. I mean, you know, you and I have talked about raising money. We talk about it, you know, but we talk about it from a very different angle. It's like, what would we do with it? What would that unlock? We don't need it, but it could, you know, like, it's just a very different set of conversations. Like, we're going out of business in 3 months and we need money. And I think, you know, that translates through to, you know, that initial 8 companies, 6 years later, they're all in business, right? In fact, you know, I think at least 4 of them are over $1 million in revenue. And I know 2 of them are over 8 figures in revenue right now. And so, you know, I mean, these are, I don't know. I mean, you tell me. I mean, I'm obviously like, I'm in the weeds on this stuff. So I see all the things that are working. I also see a lot of the things that I would want to change, but I'm curious how it felt to you stepping into the indie community, and maybe how it's, you mentioned like, now as a scout, you kind of think about someone like, would they really fit into what it is we're trying to build here?
Yeah, so like I said, it was a surprising element to me. So pre-COVID, one of the benefits to being in the indie cohort is that you do 2 retreats per year. So we got to participate in 2 in our first year, one in Salt Lake City and one in San Francisco. And what was really cool is like, you've got these funds, right? So we were V3, and there are other companies in V3. And one of the things I feel like you did really well is like bringing the V3 cohort together. So I felt like immediately I had a bunch of kindred spirits that were on a similar path, that had just entered like a similar phase in their business, even if we had like differences in revenues. And then I feel like you did a really great job to like bring in speakers and advisors that really fostered like where we're at. So I feel like you curated people that were like, here's how we bootstrapped for 10 years and built a $100 million business, or here are some of the pitfalls that we experienced with sales early on. So I feel like the people that you brought in were very instrumental in like Matt and I's learning and building our business. It was just very like on point. And then one thing I do want to highlight is like, one of our favorite parts of being part of the indie cohort is like the relationship we built with you, Bryce. It's actually like really a testament when I go out and talk to other people who are maybe in due diligence or early phases with negotiation, and how transactional the relationships are. You know, like you just touched on something, like when we're talking about fundraising, we're talking about it from like a team component, from a team aspect of like, what's the best thing for Simply Eloped? What would we actually do with that money? How do we avoid some of the pitfalls that we made when we first got the indie money, which was like hiring all of our like wish list people, you know? And so I like love that the conversation that we have on a monthly basis is not like, how are you going to make me and my LPs more money? When are we going to see that exit event? You know, like, come on, let's get on it. Like, why aren't you growing faster? It's more like, what are your challenges? How can I help? Who can I introduce you to? Like, what are we struggling with right now, and how can we get past that? And I think that is such a beautiful gift that you give, truly. So yeah, for us, like I talk weekly with some of the people that were in our cohort. I've made connections with other people in other funds. And overall, I feel so like loyal to this community because we've gained so much from it. You know, we've learned so much. We've gotten advisors from the retreats. I mean, like top to bottom, any aspect of integrating into Indie has like had a really positive impact on our business. And I just think that like we're not just getting money. We're not just getting an advisor. You know, we've got someone in our corner. We've got a community. You know, we've got other people that, like, we've got another company off the record that they have like weird seasonality in the same way we do, and we're like, how is it possible our seasonalities are like matching up? We're totally different businesses. Like, there's so many layers of how it's like benefited us. So it's one of my favorite aspects of Indie personally.
Well, you give our pitch way better than I do. So I appreciate everything you bring to the community too, because, you know, no one can ignore J-Dub when she walks into a retreat. That's for sure.
I would really love to know, and I'm so curious to hear if it's evolved. What do you look for in founders that you invest in? Like, I'm sure you have the application and you're very interested in the company and the sector, the industry, the market cap, all that really exciting stuff. But I'm really curious to know, like, when you're interviewing founders, what are you looking for? What are red flags? Like, what stands out to you? I would love to know that, especially since it's probably pertinent to the people watching.
Yeah. I mean, I think, you know, the red flags are, it is a new language and it is a new idea somewhat for people around Indie. And so, you know, the red flags are like when people start talking about our investment as like a seed round, or when they start talking about our, you know, they talk about how long the money's going to last before, you know, they've been coached to talk in such a certain way. Like, you know, everybody knows these days you're supposed to raise 2 million for a seed round. And so like when you actually push back on like why 2 million, normally the answer is like, well, because that's kind of what, isn't that what you guys need? Like, isn't that what people need to see? And so, you know, I would say the red flags are just like people who've really bought into kind of this kind of mainstream, you know, startup conventional thinking, I think is telling. I would say, you know, and that feeds one of the things we look for, which is like a lot of people kind of parrot back what they read off the website or what we've written. And what we're really trying to figure out is like, do they really get it? And, you know, do they actually value this, or candidly, can they just not raise money from anybody else? And so they think like we're going to have some like lower bar for them because, you know, we aren't out there saying you have to have, you know, this has to be a, you know, billion-dollar business in 3 years. I think what they miss in that though is, you know, and this probably, you know, this, I think you're a really great embodiment of this, which is like, you know, I think you are every bit as ambitious as any founder you're reading about on TechCrunch. Like when you talk about what it is you want to build at Simply Eloped, you aren't like, hey, we want to build a cool business in Boise and it's going to be like, we're in this cool little industry of weddings and like blah, blah, blah. Like when you unpack what it is you're actually trying to do, like it is big, it's ambitious. You have, you know, an eye towards like a venture scale kind of business, right? And I think when we meet people like this, that, you know, that who recognize like, look, I have that kind of ambition, but I know like I'm in a sector that VCs don't love right now. So I know like the bar I'm going to have to clear is just going to be higher to get the kind of excitement and energy built around it than it is if I were in, you know, what's it this week? It's like, you know, Nifties, it's like crypto, it's like whatever it is. Like there's something this week that's really, really hot that people are genuinely excited about. And so if you're out, you know, if you stand outside of that, whether geographically or industry, you know, I think we look for that in a founder. Like, do you recognize you're in a, you know, that you do have a kind of an uncapped opportunity in front of you? Do you recognize the value of kind of getting the foundation built properly, and that comes through like really hardcore focus on fundamentals, revenue, profitability? And I mean, you know, I mean, look, I know what your numbers are, and I know that 90% of those companies that are closing Series A and Series B at 40, 50, $100 million plus rounds or evaluations, like I know your numbers are better than theirs. I do. And so, but I know like you're in a category that people don't really understand and love yet. And so, you know, if you keep building, you'll be able to show like, yes, you know, we got our toehold in elopement, but there's these adjacencies, or like there's a generation of kids that are coming up that value this kind of ceremony versus what, you know, you guys did, right? And so, you know, I think those are the things we look for. And then, you know, it's just like, you know, how much time we spend together, you know, how much, you know, a personal relationship means in the context of like the crucible that is trying to build, you know, and scale a startup. Just people that we resonate with, who we want to spend time with, who that, you know, who not only get what we're trying to do. And then, you know, I think the last one being like, there are people who bring a wealth of experience to our cohort that like is going to help augment the conversations and, you know, the kind of communal learning that we're all doing together. And so like, you know, this time around we added a company where, you know, one of the founders on that team has, you know, tons of kind of paid acquisition experience, and, you know, has sold hundreds of millions, if not billions, of products online. And like that experience already is proving valuable. They're already, you know, doing one-on-ones with other people at different companies within the cohorts. And, you know, I think it's those things we look for too.
Sorry, who's this person and why haven't we hit them up for a one-on-one?
He's Garrick over at Fresh, and I will definitely get you guys talking.
That's
He's great.
funny. Let's take some questions. Bryce,
do
can
it.
you access chat, or do you want me to read the questions?
Oh, I can.
Okay.
Cool. Maybe
Although now for some reason my cursor disappeared. So can you pull?
Sorry, Mike, were you saying something?
yeah, I was gonna say we can actually just call them to come on if we want.
Oh, that's a better idea.
Hey,
Go for it.
Pablo, do you want to jump on?
Yeah, absolutely. Thank you guys. This has been amazing. Thank you for putting this together. I'm just loving every single bit of this content. I wish I had known about you guys a while back. Anyway, to the question, to the point. You know, given how founder friendly, you know, you guys are, I feel like some of the issues that we have with traditional VCs is that, you know, we run. Sorry, I forgot context. We have a marketplace. We connect developers with client work. It's a very successful and profitable marketplace, but we're thinking about growth, right? And we want to grow. Traditional investors will tell you that you either need like a really high growth figure or to stay focused doing what what you're doing. So in our case, it's either expanding the market or expanding the technologies, you know, that kind of growth. But internally, we've talked about it, and we've talked to our customers, and we've realized that there's also a lot of value in creating new sort of products, like adjacent products, right? Like if you talk about adjacent theories, things like, and last night I was listening to Parker Conrad talk about
I was gonna say,
compound,
man, that compound startup.
The compound startup, yes,
showing up in chats today. That's crazy.
Yes. I think he coined the term last night, and I'm using it today. So I will give credit to him. I think so. It's amazing that we think about that internally. And we say, hey, we have the developers, we have the community, we have the clients willing to pay us, they trust us. Why don't we start with tinkering with cohort-based courses, or some different HR tool that can help them integrate everything they have? But again, traditional VCs will tell you no, focus, and do one thing and do it really well. So with that context, like if we come to you and say, hey, we want to raise X amount of money and we want to put 80% of that to experiments, like, is that too risky for you? Like, do you guys have a formula of like how much you would let us spend in what we are really good about and what we want to experiment with?
I think that's a really good question. I mean, I think there's a reason we invest when we invest, right? We don't do pre-product. We don't do, like, you have to have something, and something ideally that's working and working reasonably well, because the way we think about it is really like, we want to be able to provide risk capital for you. Right now you have cash flow and maybe you even have profits, but all of that just like Janessa was talking about, like, they were plowing that all back into the core business. It really didn't set them up in a way to like experiment with different models, different pricing, they were so constrained by not upsetting the apple cart of what they already had that, but doing that out of cash flow was really kind of limiting their ability to do that. And so, that's how we think about it, frankly, is like, this should be risk capital. Like, we're okay losing it. You already have a business that's working. It may or may not be profitable, but it's like generating cash flow. And if our investment goes away, you probably still have a business to run. And then, and then we just get our return out through the cash flow component of it. But, the big risk we see with people, particularly who have existing businesses, is they're almost afraid to, I mean, Janessa, how many times do we have to talk to Matt about, like, dude, you raised this money, like, go spend it. Like, let's go.
Every day.
Yeah, I mean, let's put it to work. I mean, the flip side, or the risk of having something that's working, is people don't want to like mess with that, right? They're so worried about losing what it is they've already built that they can't step outside of it. So we would never put constraints around how much or where people spend it. But I think a tagline we used for a while was something along the lines of like risk capital for real businesses, right? Like, something that sat outside your cash flow, that sat outside your revenue, that was just pure risk capital for you to make some of those bigger bets with, is kind of how we think about it.
Love it. Thank you, Bryce. Sounds like a match. Meeting myself.
Awesome. Thanks for the question, Pablo, and share more, Bryce. Cool. Hey, Sharik, did you want to jump on?
Yep. Hey, Bryce, this is Sharik here.
Sharik, great to meet you.
Same here, Bryce. It's really very interesting to hear both sides of the story from Janessa and from your end, from a founder's perspective and as an investor. So just to give you a bit of a context, we've been growing pretty well, almost 70% month over month for the last 6 months, and profitable as a marketplace. So we essentially connect companies to consultants on a platform where they can do project work, one-on-one calls and surveys. We do have someone from SAP who's also an angel investor. So I love the Qualtrics story that you talk about, and I really believe in that, what Ryan has done with Qualtrics. And that was and I had a chat with Mike, I think a couple of days back, with Levi as well. And we were talking about this thing where, should we take money from VCs right now in our seed round? Or should I just go ahead with, other investors who are from rolling funds or angel investors? My personal problem is I do not like the way they talk. Yeah, I mean, I've spoken to multiple VCs. I just don't like that as a behavior pattern, right? Where they only constantly talking about how much X you're going to grow so that they can raise the next round of fund for them. Although everything, the valuation is on paper, right? In reality, you don't know how much the company is generating revenues or the impact that you have on the customers.
Yeah.
I wanted to know what's your view on this based on your current portfolio of companies. Thinking like Indie.vc plus rolling funds plus angel investors, does that make sense in the first place? Because don't get me wrong, we don't want to be, we're not saying that we don't want to grow the company big, but at the same time, I don't think this is the right time to get a VC involved at
Yeah.
seed stage, which changes the course of the business, or I won't be able to do the things that I want to do with the business.
Yeah.
So what's your view on that, Bryce?
That's a great question. Is it Sharik? Is that how you pronounce it?
It's actually Sharik. It's very close to
Oh,
Sharik.
Sharik. Okay.
Yeah, yeah.
It's great to meet you. No, look, I think you're being really intentional and thoughtful about how you're approaching this. I mean, I do think, for a lot of founders, they really don't appreciate the business model that drives venture capital, right? And so, as you bring on investors, understanding their motivation and understanding the business behind their check is incredibly valuable, right? And so, I think, we had this kind of pithy comment a while ago, playing off the JFK, quote, which is basically like, don't ask whether venture, don't ask whether you're right for venture capital, but whether venture capital is right for you, right? And I think too few people are asking that question, because I think the default is always like, well, of course, just, the goal is to raise venture capital in those early days. And so, I think with the bevy of options that are out there, like I said, I mean, between these kind of rolling funds, the indies, there's one way to kind of neutralize the effect of any one model by having a bunch of them around the table early on. The risk in that is you then have a lot of voices and a lot of incentives and a lot of different risk tolerances. Right now, everything is up and to the right all the time for everybody, whether it's crypto, Wall Street, startups, but when and if the tables do turn, there are some people who really freak out. They have a very different relationship with money. And they're going to feel that in their rolling funds. They're going to feel that in their angel investments. And, I think part of insulating yourself from that is to kind of really be intentional about who you choose to work with. And, I think you probably feel it in talking to investors. You recognize that, when you talk to Indie or you talk to an angel, you talk about it very differently than you do when you talk to a VC, right? With the VC, I would imagine you talk in way more grandiose and more definitive terms. And when you talk to people you can be real with, you're willing to kind of share some of the vulnerabilities of, or reasons for, different, kind of reasons to preserve optionality, particularly right now. And so, I think Indie tends to play pretty well. I mean, we typically, Janessa mentioned off the record, they wanted to raise a little bit more money than we were comfortable writing on our own. Typically, in Janessa's case, we just wrote her the full amount of the investment that we made. In the case of off the record, they were doing significant revenue at the time, and so we ended up pulling in a firm. It was actually another venture fund, and in bringing them the investment allowed us to kind of put them on our same terms, and that really helped to kind of simplify things. We've had other situations where we brought in angel investors on our terms, but we've also had scenarios where we're the lead investor, but some people don't love our terms, and so they want to just be on a more traditional safe note, and so we've been able to play relatively nicely in most of those scenarios.
All right, makes sense. No, thank you so much, Bryce, for sharing. It's just basically the thing that I need to consider is how do I manage the risks and incentives with different kinds of investor types, right? But I would rather prefer, at least for this round, not to have a VC unless I'm forced to, and just focus on operators who can actually help us grow the business and understand the pain of what it takes to actually build a business where you're doing the right things for your customers. And
I think that's great. And I would encourage you to do that. But I would also encourage you to be really explicit with that. I mean,
yeah.
Janessa, maybe you can share your recent experience with an advisor who's in the more mainstream startup ecosystem, and maybe some of the, like sometimes we aren't speaking the same language as each other, or maybe the expectations aren't as clear. And so I would encourage you, as you obviously, you want as much optionality for yourself as you can, but I would also encourage you to be really explicit about the kind of company you're trying to build, so that people know what it is they're signing up for. Because if you have people on your cap table who are really trying to build their own brand, maybe they're trying to raise their own fund down the road, they need to show those same kind of marks, and they want to be able to tell that story. And you may not want that. You may find you want very different things for the business.
Yeah, I kind of alluded to this prior, but one of my favorite things about our relationship with Bryce is the fact that I feel like he's alongside us instead of trying to push us or pull us in any direction. And this is a red flag for me when I'm talking to other founders who are doing negotiations with other funds, where they say, especially in the due diligence phase, where the firms or the angels or whomever they're negotiating with are already trying to reimagine, re-envision, push, pull the product or the services in a different direction. That's a ginormous red flag to me, because I feel really spoiled with Indie. Like, Indie and Bryce trust us to make the decisions on behalf of the business. And I do think that's like a tenet of why Indie exists, that they're like, you know the business better than anybody, you know your industry better than anybody, you know the like end goal better than anybody, and my job is to trust you to get yourself there and to help you get there. And so I would say, like, just to kind of back up what Bryce is saying, like, it's a really, really big red flag that when you're in early negotiation, or even after you've negotiated terms, that someone's trying to change your business or your product. And so, in getting really intentional about the direction that you want to go, it seems more of a normal that others will have ideas about where you should go, what you should do with your business, as opposed to like the Bryces. I think the Bryces are more rare. And so I think that's like so important when you're making decisions about the future of your company and taking capital, taking money. Like I felt like Bryce is so upfront with the terms that I didn't feel like there were any strings attached, like I know what Bryce expects. I know what Bryce hopes. And I know what Indie is going to benefit from having Simply Eloped as a part of their cohort, not just financially, like from the communal aspect and blah, blah, blah. But I have seen a lot of instances, too many instances, where there's a lot of surprises with other investments or other funds, and I think that's scary and sad, but more of a norm than what's going on with Indie.
Absolutely. No, thank you so much, Janessa and Bryce. Really appreciate your inputs on this, and I look forward to more conversations with you guys. Thank you.
I think we have one more question, and then I have like a blowout question to like end it all. So is it Tomas?
Yep. Yeah, sounds good. Cool. Good to see you again. Also, Bryce's, thanks for your time. I've definitely enjoyed this conversation.
Thank you for having the most epic hair on this call. I'm feeling like
yeah, man, for sure.
Self-aware of my recent haircut. My goodness.
Yeah, quarantine life, man. Yeah, but yeah, I mean, I definitely enjoyed this conversation because I actually connected with Janessa a few months back, and was introduced to VC, initially, and was like, whoa, this exists, like really cool. And I've been like really interested in following the burning unicorn for the past few months. So it's been great to connect and just like hear more from your perspective about what your vision is and what you're building. by way of quick intro, what I'm doing is building a company called Simple Surf. We're a marketplace that exists because we believe that a sustainable future worth living in is one where people share what we have and have active love affairs with the natural world. So what we're building is effectively a like Airbnb for used outdoor equipment, starting with surfboards. So we build like beachside surf lockers and open those up for used surfboard rentals to get people out in the world, out in the water, easily, consistently, and at low cost, which has been super fun. But
Love
the
it.
question
We're investors in hip camps, so we know that category pretty well.
Awesome, cool. Yeah, seeing their growth has been really fun too.
Same.
Yeah, one of the things that I was noticing, I was definitely enjoyed, reading through your writing on Medium, over the past few years specifically, and found that piece where you were talking about your daughter's college application.
Oh, geez, yeah.
And really exploring that tension between challenges and privilege. And one of the things that I wanted to get your thoughts on was, one of the themes that I've been hearing in this conversation is the kind of this intention with Indie to really connect on a personal level with the founders that you work with. So in the kind of like getting to know you process, especially like in those first conversations with founders, like to what extent, if at all, do those themes of challenge and privilege and kind of how they balance come into those conversations?
That's a good question. I don't know that I'm very good at that. I guess in this climate, I don't know really what I can ask or what I can't as we dig into it. You know what I mean? That probably evolves over time. I mean, I think Janessa and I and Matt have very different conversations 2.5 years in than we did initially. I mean, I think, trying to hopefully with the writing, part of my goal in writing is to have someone come into a conversation who already has a glimpse into who I am. It's not, that's not marketing stuff. That's, I'm trying to make, myself as understood as I can so that people can come in and trust or not trust or have questions. I think the questions that I probably want to get better at understanding candidly, that I've come to appreciate how this impacts people, particularly startup founders, is their relationship to money. And I know that's I haven't found a good way to understand it yet. But I've now watched over the years so many people who come from very different backgrounds, all of a sudden having meaningful amount of money in their accounts, and it affects people very differently, right? Some people, for instance, in V1, we had a founder who runs a company called The Shade Room, which is a media company. And I wrote about this a little bit, but it was, she told me later that she never spent the money we gave her as an investment. And given my relationship to money, what I thought that meant was like, that was a badge of honor for her. Like, we're doing so well, we didn't even have to touch it, we're crushing it, right? But as I unpacked that with her, the reason she didn't spend it was because she didn't want to lose it. She was afraid that if something went wrong, I was going to come back and demand that money back. And she wanted to be sure that it was there. And so despite the fact that, Shade Room is now a, 8-figure media business, huge reach. But at the time, she was very much a foster kid from the inner city whose dad killed her mom and who always had an incredibly tenuous relationship with money, who had a very scarce mentality about money. And I think, you know, when I look at the flip side of that, we obviously have people who come in who are like YOLO, right? Like, hey, I got this risk money, I can like, I'm gonna blow through it because now I, you know, and so I think I've become more and more aware of people's relationship to money and what it means and what it, you know, why it matters in terms of growing their business. And I'd like to figure out better ways to expose that early on. I don't know that I've done a great job getting to people's, especially in the first meeting or two, getting to their real intentions and real motivation, because candidly, the investor to founder relationship is so performative. You know, it's really hard to cut through it. Like, you aren't, you know, the reality is like, you're not here to be my friend. We aren't here to be buddies right now. You know, you're here for money. And I think, you know, trying to kind of figure out how to square that, because over time, the relationship totally evolves. Like, you know, I've been to a bunch of founders we've funded weddings. I've been involved. I'm on Christmas card lists. I'm on, you know, all the stuff that, you know, as the relationship evolves, but in that kind of initial get to know you, do we want to invest? I've found it is harder for me, and particularly given the pace of fundraising these days, to kind of crack through meaningfully. It really is in so many respects just you know, building some level of trust or connection early on. And you know, I think that's hard too, because you know, I for one am very susceptible to having my ego stroked. And so when someone comes in and says, "Oh, I love Indie, it's so amazing," like, oh, blah, blah, like, it's such like music to my ears. And you know, over my career, I've allowed it to really affect and inform some really bad decisions over time. And I think I'm trying to be better at separating what it is we're building, what I'm hearing, and you know, our decision-making process.
So Bryce, I want to be mindful of time. So I have
Okay, we
like
got 2
one
minutes.
last blowout question for
Hey,
you.
thank you for that one.
So I don't know if everyone's aware, like Indie has a bigger reach than just the cohorts that they invest in. So Indie has the cohorts and the V3s, V4s. I think we're up to V6 now. But then you also have Intro, which I think is getting a facelift, and then you have the Scout program. So in your 6 years, you've done a lot. I would like to know, outside of like making LPs as happy as possible, I'm curious, in 5 to 10 years, if you could just like pinpoint one thing that you would really like to see in Indie or in the community or having an impact. I personally would love to know, like, what would that one thing be? If you could just be like, that is where we're going, or that's what I want, or when this happens, I will feel like we were successful. I would just love to know that, outside of money.
Yeah, I think, I mean, I've talked about this a little bit with the Scouts, but you know, I think for me, the next evolution in kind of the constellation of relationships around a firm right now, people really are gravitating towards like community is what they've been calling it. And really what that means is like, you know, the hub and spoke of the fund kind of creates this community, they create the content, and then they create these kind of networks around themselves. And I think that's, I think if we get anything right, in 10 years, we'll look back as that being like the primordial soup of what we call an economy. So, you know, we talk about it in terms of like, what's the Indie economy? And so right now, you know, the kind of early iterations of that are things like the Scout Network, right? So in the Scout Network, you know, economies kind of have a different kind of currency. And one currency we have as a fund is to kind of lubricate the economy with these referral fees. And so when a Scout refers a company to us that we end up funding, we pay them $10,000. From that $10,000, many choose to kind of co-invest alongside of us. So they're getting on those cap tables. With Intro, that's another piece of the economic kind of underpinnings we're trying to develop, which is intro is like this front end to 50 plus non-dilutive funding options for founders. Of each of those products, we've created an economic relationship with the underlying lender so that when a scout refers someone into intro, those economics in terms of cash flow directly back to that scout, so that the lender is paying the scout instead of the lender paying Google or some other, kind of front end for their lead gen. And then, I mean, I think we've talked about this a little bit. I don't know that we've talked about it publicly much. We've been developing what we call an advisory directory. So right now we have this kind of large network of scouts. There's 400 plus scouts in there. And we're trying to give them kind of more ways to participate economically in what's happening with Indie. One way to do that is to create advisory relationships with the underlying portfolio companies. So we have been building out a directory of all 400 of those scouts that as our founders go and say, hey, like I really need an expert in X or Y, or I really need someone with, experience working at, Z company, that we can, one, make them discoverable, and two, create kind of some rails that make it really easy for that person to say, wow, you're really valuable. I would like to have you as a more formal advisor. Click, let's give you kind of an option allocation. Let's put you on our cap table. So again, like we're moving from a cash component of the economy to an equity component of the economy. And so I think if we're successful, when we look back 10 years, I think you will see the shift in VC and funds that is like, there's far less hoarding of the resources of the fund and more seeding the economics around the fund, be it deal flow, be it advisory work, be it, investing. Like that's my goal, is how do we create, kind of a larger economic impact here for those who want to come along for the ride. And, inviting people along for the ride, like you say, we do a lot, but I think we have to figure out how to do even that much more and how to make the bus that much bigger that people can get on to come along for the ride. That's the goal.
I love it. I'm honored to be a part of that vision and future.
Well, we are honored to have you be along for the ride.
Awesome. Well, that was a great way to wrap it up. So I definitely want to be conscious of time here, but this is a really incredible chat. So thanks, Bryce, and thanks, Janessa, for taking the time to join us and share more.
Okay, so, thanks for having us.
Awesome. Thanks everyone for joining in too.
Take
Bye.
care.
I'm also in the community, so if you want to hit me up with more questions, I'm available via Slack or Twitter, and Bryce is pretty active on Twitter too. So.
Awesome. Yeah, I'll make a note in the group too, because I had a few that messaged me on the best way to reach out. So.
All right.
Everybody.
Thanks everyone.